Welcome everyone and thank you for joining us today. My name is Katie Bennett. I am the Director of Medical Markets here at High Point Financial Group. We recently partnered with MAOPS to, I think, bring to light some of the big financial issues that a lot of you have said that you struggle with. The first one that we're going to discuss today centers around debt management strategies. And a lot of the focus this afternoon, or whenever you choose to play this, is going to be around student loan debt. This is obviously a pre-recorded session, so there isn't an opportunity to have a lot of feedback. So I have put my contact information as well as Paul Rodden's contact information up on the screen for you. If you have individual questions and you would like someone to talk to you about this, feel free to reach out to either Paul or myself. High Point is a firm that's located in Overland Park, Kansas. I say Kansas City because it's easier for people, but we obviously have satellite offices in Columbia and Wichita. We've been around for an incredibly long time and we're a well-established firm, and we are incredibly excited about this partnership with MAOPS. Just a quick snapshot of some people on our team. I kept this slide in here because I think it's important to understand the different levels of support that exist within the medical markets team. So it's there for you. We obviously have a lot of options or opportunities for you in the event that you need help outside of what we're talking about specifically today. The average DO resident in debt for $215,000. Now, to me, this stat is a little bit misleading in the sense that most people who come out of medical school tend to have, at least today, a little bit more in the way of student loan debt than that $215,000, unfortunately. Most of the time, there's a combination of public and private debt, and we are about to enter a phase, if you're transitioning out of medical school and into residency, where you are about to pass your grace period. You obviously have a lot on your plate, and there is a long period of time, and I know residency time frames vary, but there's a long period of time where you're going to be at this very reduced income relative to what you're capable of making. So the question becomes, how do we deal with this? How do we address these particular issues at a time in your life where, from a financial standpoint, you don't have a lot in the way of resources? Mistake number one is to do nothing. So if you don't make an election as you exit your grace period, one of two things is going to happen. You will enter into forbearance and say, listen, I'm not going to pay anything for the duration of residency and fellowship if you choose to go that route. Or if you make no election in any capacity, what ends up happening is you will get a bill for that standard TED number. It will show up at your house. It will say that you owe thousands and thousands of dollars, and then you'll have to make a decision. For a lot of people, it's really attractive to delay paying on this debt for as long as possible. The issue with making this election is that your interest is accruing, and as it accrues, each and every year it capitalizes into the principal balance. What does this mean? What's capitalization? So what this means is that basically your interest, and let's say your average interest rate on your student loan debt is 6.5%. It accumulates on that total balance. So for example, let's say it is that $215,000. You've got this interest that builds over the course of the year, and at the end of the year, that loan interest that accumulated folds back into the loan principal. That's what we call capitalization. And then the new interest accumulates on that bigger principal balance. So what it does is it creates this very significant snowball effect over a period of time. Mistake number two is assuming that your employer is going to handle this. The issue with that assumption is that it is becoming more and more rare to see future employers wanting or willing to handle your debt balance, especially if you're thinking it's going to be handled in its entirety. A lot of times, if you are willing to go to a more rural location, you will have the capacity to have some of your debt forgiven or paid for by an employer. Meaning, if you're willing to move outside of town for a period of, let's say, for example, 5 years, you may get a stipend of $25,000 per year to put towards your student loan debt. Well, for most people, the issue is, one, this isn't going to cover the entire loan balance, but two, there are often tax implications associated with this. Meaning, if your employer gives you this money, you will also generally receive a 1099 for that, in my example, $25,000. So it registers as additional income to you. It's not free money. And then the last issue with this is that you have to be willing to traditionally live outside of a more metropolitan area for a period of time. And if you violate those terms, then employers have the ability to come back and request that money from you. Inside more major metropolitan communities, this almost never happens. It is a very risky assumption to make that this loan forgiveness or loan assistance is going to be available to you. But this kind of takes me back to our previous slide in the sense that it's really important that you mitigate that snowball effect to the best of your ability so that your debt doesn't spiral out of control as you work through residency and fellowship and you're not dealing with a bigger lump sum on the back end. Mistake number 3, how to pay. There is a best way to tackle student loan debt for every person out there. Your best path or the best way for you to pay is directly dependent on your family size, your career path, how long you're going to be in residency, the cash flow that you have available to you presently, whether or not you're married, so on and so forth. So when we're talking about this, know that I'm just giving you a very brief sort of overview of what is possible, but this is not a hard and fast rule for everyone because it is very dependent on your personal situation. The options that are available or that exist. So the standard 10 plan is the plan that says you're going to make 10 years worth of equal monthly payments. And by the end of that period of time, you'll have paid off your debt completely. There's also a graduated option, which says that your payments will still be paid off in a shorter period of time, but the payment level or the payment amount starts a little bit lower than that standard 10 number, and then every year as you move forward, that payment increases. The assumption behind this plan is that your income goes up over time, hence your payment going up over time. The extended repayment plan lets us know that instead of working in a 10-year time frame, we are extending that time frame out to 25 years. You're still paying off your debt completely, but it's a longer time horizon to keep the payments a little bit lower. There are a few federal student repayment programs that are available to you through the government. So these are related or very specific to your federal student loan debt. That's the only place where these next 3 options apply. One, pay as you earn. Another is revised pay as you earn. That's sort of an updated version of the traditional plan. And then income-based repayment. There are a few other options, but most of those don't exist or aren't available for people who would have traditionally taken out loans when I'm assuming that most of you have. All right, so we talked about this a little bit already. The standard repayment plan, it's that 10-year required repayment time frame. It's a levelized monthly payment over that period, and then at the end of this time frame, you'll have completely paid off your debt. Every person has the ability to take advantage of this particular plan. The big issue is whether or not, from a cash flow standpoint, you can afford to pay on that 10-year level plan. This graduated repayment plan is traditionally 25 years. That's the traditional time frame that you'll see. Again, this is a plan where every borrower is available or has access to this particular type of repayment option, but it is a scenario where you're going to pay still the same total loan amount, plus, obviously, because it's a longer time frame, you're going to be paying more in the way of interest, but that same levelized contribution amount over a longer period of time to help make this a little bit more affordable for most people. If you look, by the way, in this second column where it tells us about eligible loans, just about every loan is eligible under the Standard 10 and under this graduated repayment plan. So all federal loans should count towards this. The pay-as-you-earn plan is a little bit different. This is the first plan that we're going to talk about where your required payment amount is directly associated with the income that you are making. So pay-as-you-earn says that you are going to pay 10% of your discretionary monthly income over and above the poverty line, right? So what that means, or what that tells us, is that the more people you have in your family, the bigger your family size, the lower your required payment amount, because your poverty line is a little bit higher, essentially. A family of 4, let's say a married couple with 2 children, is going to have a lower required payment amount than a single person when both participants are making the same amount of money, let's say $50,000, for example. Your required payments are recalculated each and every year. In this particular type of plan, the thing that you have to keep in mind is that if you have a spouse and that spouse works and you file your taxes jointly, that person's income is factored in when determining your required monthly payment amount. So to recap, this plan is 10% of your discretionary income over and above the poverty line. You're going to pay on this debt for 20 years. At the end of 20 years, if you still have debt that exists, then it's forgiven and that remaining balance becomes taxable income to you at that time. Let's say, for example, that you still have $75,000 that you owe on your federal student loans. At the end of 20 years, that $75,000 will be forgiven, but it's forgiven on a taxable basis, so it looks like in that particular calendar year, you made an extra $75,000. Traditionally, this is still better than paying the $75,000. It's just a mental note that you have to make for the future. The benefit to this plan is really a couple of things. One, it is the lowest required payment amount, meaning 10% of your discretionary income, available. 2, the shortest time frame under these federal repayment options that are income-based. And 3, lastly, you have the ability to file your taxes separately if you choose, so that your spouse's income isn't factored into your required payment amount. The hard part about this particular plan is that you have to have student loan debt that exists within a certain time frame. So you can't have any federal student loan debt that exists before 2008, October of 2008. If you do, it automatically makes you ineligible. The other element of this is not every federal loan qualifies. However, traditionally, if you have loans that on the federal side that don't qualify, if you consolidate your loans prior to repaying, then you have the ability to convert those loans into something that would be eligible for this particular plan. The revised pay-as-you-earn plan is very, very similar. The difference, because this is sort of a revamp of that traditional pay-as-you-earn platform, the difference in this one is that that element of having student loan debt, federal student loan debt that originated at a certain juncture and not before, goes away. So they were trying to make the pay-as-you-earn plan a little bit more available to people, and this is the version that they came out with. It's still 10% of your discretionary income, but instead of the repayment time frame being 20 years, if you have any post-grad debt, which all of you do, it will be 25 years in terms of repayment terms. So 10% of your discretionary income over a 25-year time frame. At the end of 25 years, that debt is forgiven, and again, it's taxable income when it's forgiven. One of the key differences on this particular repayment plan is, one, you do not have the ability to file your income taxes separately from your spouse. So if you are married and your spouse works, that person's income will be counted or factored into your required repayment amount, regardless of whether or not you file your taxes separately. So there is no point in filing separately under this particular plan if you're married. The other element, and this is a positive in favor of the revised pay-as-you-earn option, but the other element has to do with the way that interest accumulates on this particular plan. The benefit to the revised pay-as-you-earn option while you are in residency or fellowship, when you're at a phase in your career where your income is really suppressed, most people who are working through this time frame don't have the required payment amount that is issued to them that covers the interest that accumulates. So let me explain this a little bit differently. If, let's say, on a monthly basis, based on your total loan amount and the interest rate that is associated with your loans, let's say that you accumulate interest at $1,000 per month. But, for example, your required payment amount is only $200 per month. What it means is that you still have $800 per month of loan interest that's accumulating. Now, while you're in these repayment plans that I've been discussing, the income-driven repayment programs, the pay-as-you-earn, the repay, the income-based repayment, your loan interest isn't capitalizing. It's no longer folding back into the principal, but it still accrues, and it's still something you're responsible for on the back end. So in order to mitigate some of this liability, what the repay program says is that half of the loan interest that accumulates while you're in this phase is subsidized by the government. Going back to my previous example, if you've got $1,000 a month of total loan interest, and what you're paying is only $200 a month, you've got $800 worth of loan interest that isn't being covered that would accumulate under other plans. In this revised pay-as-you-earn scenario, $400 of that, or half of that $800, is forgiven by the government. So this is a really good way to minimize or mitigate some of that snowball effect that people can experience while they're working through the last half of their training, residency, and fellowship. Income-based repayment is the oldest of the three plans. Income-based repayment says that you're going to be paying 15% of your discretionary income that's associated with the post-grad debt, and you're going to be paying on it for 25 years. At the end of 25 years, if you still have a balance, it's forgiven, but it's taxable income to you. Going back to my original example with the pay-as-you-earn plan, this is one of those plans where you have the capacity to file your taxes separately from your spouse. So if you have a spouse who works, and especially a spouse who makes a more significant amount of income, this potentially is a place where it makes sense for you to file your taxes separately. Most all federal loans are eligible on this particular platform, but if they aren't, then you have the ability to consolidate, and most of the time that will make the loans that were ineligible eligible. Consolidation is a tricky one because it's not always needed or advantageous. What consolidation does is basically take all of your separate student loans that you accumulated during your time as a medical student or undergrad student or whatever the case may be, and Consolidation takes all of those federal student loans and lumps them together into one individual loan. The benefit to this can be you're taking sometimes loans that aren't eligible for certain repayment programs and you're making them eligible. But what consolidation truly does, outside of making everything a little bit cleaner, is it kickstarts the repayment process. I'll give you a good example of that. When you leave school, you have a 6-month grace period. So whatever med school you attended will basically send a letter to the government upon graduation that says, Dr. Smith just completed his or her medical school and is now moving into the grace period. You've got 6 months of that before you're required to start making payments. Sometimes it makes sense to skip that grace period in very specific circumstances. So one way to do that is to consolidate your loans because it automatically kickstarts your repayment. It throws you back into repayment when you otherwise would not be. There are other times where it doesn't make sense in any capacity to consolidate, and then it's just an extra step. It's just one more thing to do. And when we're talking about a lot of this stuff, we're really focusing on federal student loans because that tends to be the bulk of the debt that people have. When we're talking about this, really on the federal side, when you're dealing with the government, it takes some time. So you've got to know if it's not necessary, don't mess with it because it's not worth the headache. In the last few years, it's become very popular to look to third parties to handle either your federal student loan debt, your private debt, or both. Here's my advice on this particular front. Do not ever assume that all third-party loan companies are the same. They are not. Each has its own set of terms and conditions. I have some that I think are better than others in terms of their offerings, and that's based on contract language and interest rates and those kinds of things. But you've got to read the fine print because there are a fair amount of organizations out there who've got some, what I like to call gotcha clauses within their fine print. So you've got to really focus on what the offerings are and whether they or not they make sense for you. What it also does is remove the ability to engage in forbearance. The benefit to some of the federal programs is that even though sometimes you might be dealing with a slightly higher interest rate depending on when you took out your debt, the issue with moving to a private debt company is that sometimes you're trading or exchanging that higher interest rate for a lower interest rate. But in doing so, you are removing a lot of the forbearance options that are available through the government or some of the options to pay on an income-driven platform or whatever the case may be. So you're taking away some of the flexibility that you had previously through the government. So before you do this, make darn sure that this is the best option for you and something that you can commit to moving forward, because once you do it, there's no going back. Mistake number 6 is really not knowing and understanding your end game. All student loan debt and loan repayment in general requires a very specific strategy. But this is not a scenario where you want to jump back and forth between different platforms and different strategies. I fully understand and respect the fact that not everybody, especially as they move into residency, for example, knows what the end game or the end chapter is going to look like for them. But in order to choose your most efficient path, you have to kind of identify what you're trying to accomplish. So I've highlighted those things below. Are you trying to have your debt forgiven? Are you pursuing public service loan forgiveness? Are you planning on working in a rural area? Will you be paying off your loans in full? What's your cash flow look like as you're moving through residency and fellowship? All these things are really, really essential options before you pick a particular strategy. There's one quick thing or element that we didn't discuss, and I'm going to jump back to it because I talk about it here just very quickly, this public service loan forgiveness option. This is one that I think has kind of been, had a little bit of buzz around it over the last several years. In order to be eligible for public service loan forgiveness, you must be paying under one of the required payment programs that I highlighted previously, one of those IDR programs or income-driven repayment programs. So that's layer number one. Layer number two is you have to work for a 501c3. Now, a lot of hospital systems across the country are 501c3s. It's a very important nonprofit status that is highlighted, but you have to make sure that your residency program qualifies for that before you go down this path, or your future employer for that matter. But so element number one is be paying under one of the highlighted IDR programs. Element number two is be working for a 501c3. If you do those two things, and lastly, you got to be working full-time. If you do those things in conjunction with working full-time, you have the ability to have your federal student loan debt forgiven on a tax-free basis after 10 years. So let's compare it to, from a time frame standpoint, the most favorable loan repayment program, which is Pay As You Earn. Pay As You Earn says 10% of your discretionary income, 20 years, and at the end of 20 years, you have your debt forgiven, and it's forgiven on a taxable basis. Public Service Loan Forgiveness, or PSLF, says, well, you pay under Pay As You Earn, but in addition to that, you have the ability to layer Public Service Loan Forgiveness over the top of it. If you meet our criteria, then at the end of 10 years, your debt is forgiven, and it's forgiven on a tax-free basis. This is one of those things where if it works into your future plans, this is where you wanted to practice, this is how you wanted to practice, this is a big thing for people to take advantage of moving forward. There has been some negative feedback or some concern about the PSLF program. It's been associated with a lot of the political rhetoric that's been going on about it. But when it comes to public service loan forgiveness, we had our first wave of forgiveness October of last year. So that was the first wave of graduates who were in the program for 10 years, and it went off without a hitch. So there wasn't a gotcha, there wasn't a so too bad, so sad, thank you for your 10 years of service. This is one of those items that's outlined in your promissory note when you take out your federal student loan debt. So it's not something you should be afraid of in the event that this fits with your future plans. Thank you all for your time and for your attention. I know that we went through a lot today. So again, if you have questions or there were things that we didn't address, feel free to reach out to Paula or myself independently. We're happy to talk to you about those things. We are very excited with our partnership with MAOPS, and we are committed to helping people who are part of that organization. So please feel free to use us as a resource as necessary and as needed. Thank you again, and enjoy the rest of your day.